Imagine owning something, a security, right, with a mandatory redemption date.
Yeah.
Only to find out the company might just, well, tell you to wait. Or that the board's main job isn't actually paying you, but looking out for someone else entirely.
Right.
This isn't bonds. It's not common stock. This is the complex world of preferred shares. We're looking specifically at call features and this, well, surprising reality of redemption risk for U.S. income investors.
It's a fascinating area and often misunderstood.
Welcome to the deep dive. We've got a whole stack of sources here, reports from RBC, Saxo Bank, analyses from Investopedia, Foley and Lardner talking about legal obligations.
And that Montague Law piece on tax implications, too.
Exactly. So our mission today, let's take all this, pull out the critical insights, the stuff you really need to know, cut through the jargon.
Get to the practical implications, especially if you're looking at preferreds for income.
Yeah. What are you really getting into when you add these to your portfolio?
That's the key question. Because preferred shares, they often get grouped with bonds under income investments, but honestly, that comparison only goes so far.
Right.
Understanding the mechanics, the risks, especially these call and redemption features we're talking about, it's fundamental. They really are hybrid instruments.
Hybrid.
And that hybrid nature, it introduces complexities, risks you just don't see with plain old debt or common stock.
Okay, let's unpack this then. What exactly are preferred stocks at their core?
Well, the sources define them pretty clearly. They're this unique type of security. They sit somewhere between bonds and common stock in a company's capital structure.
Between bonds and common.
They absolutely are. You see, companies issue them as another way to raise capital. It's different from selling common stock.
Right. Common stock is ownership, voting rights, maybe a slice of the profits through dividends that can change.
Exactly. And it's also different from issuing debt, like bonds. With bonds, the company is borrowing money. There's a legal promise to pay it back with interest by a set date.
Very clear obligation there.
Very clear. Preferred shares, though, they offer companies capital in exchange for something that looks like a fixed income stream. But legally, it behaves much more like equity.
So they pay a set dividend, generally.
Yeah.
That's the income piece investors look for.
Yes, generally. Preferreds typically pay a stated dividend. It's often calculated as, say, a percentage of the share's par value, maybe $25 is a common one.
Okay.
And all these terms, the dividend rate, the par value, all that it's laid out when the shares are first issued in the prospectus.
Got it.
And here's a really key point. A lot of preferred shares don't have a set maturity date. They can, in theory, exist forever. They're perpetual.
Perpetual, no end date.
But, and this is a big but, they are very, very often callable.
Callable. Okay, we'll definitely need to dig into that.
We will. It basically means the company that issued them has the right, but importantly, not the obligation, to buy them back, to redeem them.
Okay.
And crucially, even though they have these bond-like dividend payments, legally they're classified as equity.
Still equity.
Yeah.
Despite the fixed-ish payment.
Right. Sometimes on a balance sheet, especially for non-financial companies, you might see them presented as sort of a hybrid, maybe 50-50 debt equity for reporting, but legally, equity.
And where do they stand if things go really wrong, like liquidation? Where are preferred holders in the queue?
The capital structure question. So preferred shares are subordinate to bondholders.
Meaning below bondholders.
Exactly. Bondholders are creditors. They loaned money. They are first in line to get paid back from any assets if the company folds.
Makes sense.
Preferred shareholders come next. They are senior to the common equity holders.
Okay. So bondholders first, then preferreds, then common stockholders get whatever's left, if anything.
Precisely. So once the bondholders are satisfied, preferred shareholders have the next claim on remaining assets. Common shareholders are last. That priority in liquidation is a significant feature compared to just holding common stock.
Okay, that's liquidation. What about when the company's just operating day-to-day,
Yeah.
like with dividend payment?
Right. Yes, another area of priority over common stock. Preferred shareholders have a higher claim on dividends than common shareholders, and this is quite strict.
Oh, strict.
A company is legally prohibited from paying a common equity dividend if a preferred dividend isn't current.
Wow, okay.
So if they want to give any cash out to their common shareholders, they must first make sure all the preferred dividends that are due have actually been paid.
That sounds like pretty solid security for someone looking for income.
It's definitely more security than holding common stock, yes. But, and this is a critical distinction, the sources really hammer home it is absolutely not the same as a bond's interest payment.
Not the same. How so?
Preferred dividends are not legal obligations in the same way bond interest is. A company can legally suspend preferred dividends, and common dividends too, for that matter, without actually defaulting on its debt.
They could just stop paying without legal default.
Legally, yes. Now, actually doing that, it would be a massive red flag to the market. It would seriously damage the company's reputation, make it much harder and more expensive to raise capital later.
Right. You wouldn't want to do that lightly.
Not at all. Typically, common dividends get suspended first if things get tight, but preferred dividends can be suspended if the company's financial health is bad enough that paying them might risk their ability to pay their bondholders. The key is, the company has discretion. The obligation isn't absolute, like debt.
Okay. So priority over common, senior in liquidation to common, but the dividends aren't a 100% legal must pay like bond interest. What happens if they do miss a dividend payment? Is that income just gone?
That leads us to a really crucial difference between types of preferred shares, cumulative versus non-cumulative dividends. Vital for income investors to understand this.
Cumulative versus non-cumulative.
Okay. If you hold a cumulative preferred share and the company misses a dividend payment, that missed payment doesn't just disappear, it accrues.
Accrues, like it piles up.
Exactly. It basically piles up as an arrearage, money owed. And before the company can ever pay any future dividends to common shareholders, it must first pay off all those accumulated missed preferred dividends.
I see.
So that cumulative feature, it provides a really significant layer of security for the income investor. It means missed payments have to be made up eventually if the company recovers and wants to reward its common shareholders.
Okay, that makes sense. So what about non-cumulative?
With non-cumulative preferred stock, well, it's much simpler and riskier for the investor. If a dividend payment is missed, it is gone forever.
Oof.
Those dividends do not accrue. The company has zero obligation to pay them later, period.
Wow.
This makes non-cumulative preferreds considerably riskier if you're seeking consistent income, obviously. A missed payment is a permanent loss of that income for that period. You absolutely have to check if a preferred is cumulative or non-cumulative before you invest.
Okay, good tip. So recapping the basics. Hybrid nature, middle to capital structure, dividend priority with that crucial non-cumulative difference. But dividends aren't legally mandatory, like bond interest.
Got it. Now, let's get into that callable feature you mentioned. That sounds like a big deal.
It is a very big deal.
Yeah.
And it's one of the most common features you'll find. Most preferred shares are indeed callable.
Most of them. Okay.
And what that means is the issuing company has the right, again, explicitly not an obligation to redeem the shares, to buy them back from investors at a set price, but only after a specific date.
A specific date.
Right. That date is clearly defined in the prospectus. It's known as the first call date.
And why would a company want to exercise that right? Why call back shares they already sold?
The main reason, refinancing. It's almost always about reducing their cost of capital.
Like refinancing a mortgage.
Exactly like that.
Yeah.
Think about it. If a company issued preferred shares a few years back when dividend rates were higher, say, they issued a preferred with a 6% dividend.
And now, today, market conditions have changed. Maybe they could issue new preferred shares with only a 4% dividend rate.
I see where this is going.
It makes total financial sense for them, right? They can call back the older, more expensive 6% shares, pay the investors back, and immediately issue new 4% shares. They save money on dividend payments going forward.
Okay, but for the investor, that's the risk. Call risk.
Precisely. That is the direct risk for you, the preferred shareholder. If you own a callable preferred share, especially one that's trading in the market at a premium, say above its call price, which is often par value, like $25.
Right.
And interest rates or prevailing dividend rates have dropped since it was issued, well, the issuer is highly motivated to call.
And what happens to me, the investor?
You get your capital back, usually at the original par value, maybe with a small premium depending on the terms, but then you're immediately stuck with a problem. Reinvesting that money. You're forced to put that capital back to work in a much lower interest rate environment. You're pushed out of potentially a nice, higher yielding investment into a market where you can likely only find significantly lower yields.
So it's like the borrower paying off their high-interest loan early because rates went down.
Yeah.
But you were the lender enjoying that high rate.
That's a perfect analogy. You lose that desirable income stream. The prospectus details the call schedule. The first call date, the price, it usually says they can call at any time after that date, maybe with 30 or 60 days notice.
Oh,
Some schedules might even show the call price decreasing over time after that first date, maybe stepping down towards par value over several years.
how can you, as an investor, get a sense of how likely a call actually is?
The trading price of the preferred share itself in the market is a very strong clue.
The market price. How so?
If a preferred share is trading significantly above its par value or call price, that's a clear signal. The market is basically saying, we expect this to be called.
Because why else pay a premium?
Exactly. In that situation, as an investor, you need to stop focusing just on the stated dividend yield and look at the yield to call.
Yield to call. Okay, what's that?
It calculates the annualized return you'd actually get, assuming the share is called on its first possible call date. It factors in the dividends you'd receive until then, plus the difference between what you paid for it and the lower call price you'll get back.
So if I bought it above the call price, that difference is a loss, which drags down my yield.
Correct. It gives you a much more realistic picture of your likely return if that expected call happens.
Okay, so if it's trading high at a premium, then yield to call. What if it's trading low at a discount? Below par or the call price?
Well, if a preferred is trading at a significant discount, say, the call price is $25, but it's trading at $20, it generally means the market thinks a call is much less likely anytime soon.
Why is that?
Think about it from the company's perspective. Why would they pay $25 to redeem a share that they could just buy back in the open market for $20?
Good point.
Plus, if they were to issue new preferred shares right now, in this scenario where the existing ones are cheap, they'd probably have to offer a much higher dividend rate than the existing shares carry just to attract buyers. So they're actually incentivized to keep the existing cheaper shares outstanding.
Okay, that makes sense too. Is there a yield measure that kind of combines these possibilities? Like, what if it's called? What if it isn't?
Absolutely. And this is a critical concept for any callable security, not just preferreds. Yield to worst, often abbreviated as YTW.
Yield to worst. Sounds ominous.
It's meant to be conservative. YTW is designed to show you the lowest possible yield you could receive by holding that security, considering all the possibilities in the contract.
How does it do that?
It calculates the yield to call for every single possible call date and call price mentioned in the prospectus. Then it also calculates the straightforward cash yield you'd get if the share is never called and just keeps paying its dividend forever, assuming it's perpetual.
Okay.
YTW then simply reports the lowest yield among all those different scenarios. So it's like a worst-case scenario yield based on the contract terms.
Exactly. It's vital to know the yield to worst because it gives you the most conservative picture of your potential return. It highlights the real impact of that call feature and shows you the absolute floor on your expected yield based purely on the terms. You might hope for more, but YTW tells you the contractual minimum you might end up with.
Okay, that's really helpful. Yield to call for premiums, consider YTW, always.
Got it. Now, that covers call features driven by market rates in the contract. But the sources, especially that Foley article on the ODN holding case, they seem to dig into something much deeper about redemption risk. This feels different from just the callable feature.
It is fundamentally different, and this is where things get really complex, especially when you're looking at preferred stock. In private companies, think private equity, venture capital deals, although the legal principles can echo into public preferreds too.
Okay.
That mandatory redemption clause you sometimes see, the one that sounds like the company must redeem the shares on a specific date.
Yeah, sounds pretty clear. Mandatory.
It's not the absolute guarantee, it sounds like, not even close in many cases.
Really? So mandatory doesn't mean mandatory like a bond maturity date where you know you're getting your principal back.
Absolutely not. This is one of the biggest takeaways from the sources, particularly highlighted by that ODN case. A mandatory redemption date for preferred stock is explicitly not the legal equivalent of a bond's maturity date.
Wow.
The corporation is not unconditionally obligated to repurchase those shares, even if the contract uses the word mandatory.
So what does the obligation depend on then?
It depends heavily on the company's financial status at that specific time and, crucially, on the decisions made by the company's board of directors. And those decisions are governed by their fiduciary duties.
Fiduciary duties. And who are those duties owed to? This is where it gets a bit weird for preferred holders, right?
Exactly. This is the absolute core legal principle that drove the ODN case. In a Delaware corporation, and remember, a huge number of U.S. companies incorporate in Delaware, the directors owe fiduciary duties. Duties of care, duties of loyalty. Primarily, and in many situations exclusively, to the common stockholders.
To the common stockholders, not the preferred.
Primarily to the common. The board's main job, legally, is to act in good faith to maximize the value of the company, the entire enterprise, for the long-term benefit of those common shareholders.
Why the common, specifically?
Because common shareholders are the residual claimants. They get whatever's left after everyone else, creditors, preferred shareholders, gets paid. So the board's goal is to make that residual slice as big as possible over the long run.
And that sets up a potential clash with preferred shareholders who just want their money back on a specific date, maybe?
Precisely. A very real conflict can pop up. You've got the preferred shareholders maybe focus on getting their initial investment plus any dividends back on that mandatory redemption date. That's their exit, their return.
Yeah.
And then you have the common shareholders who usually benefit most if the company keeps that capital, reinvests it for growth, maximizes long-term value. Delaying a big cash payout to preferreds might be better for the common.
And the board is stuck in the middle, but legally leans towards the common.
Legally, their primary duty is to the common. So yes, they have to navigate that conflict with the common shareholders' best interest as their main guide.
Okay, tell us about this ODN holding case. It sounds like it perfectly illustrates this clash.
The ODN holding case, which the Foley source analyzes, is just a fantastic, if maybe cautionary, illustration of how this legal framework plays out. It involved a company called Oversea.net. They got a big investment, $150 million from a venture capital firm.
Okay, VC money.
And the investment was structured as preferred stock. Crucially, the contract included a provision saying the company had a mandatory obligation to redeem those preferred shares for cash after 5 years.
Mandatory redemption, 5 years. Got it. And the redemption price.
Original issue price plus any declared but unpaid dividends.
And you mentioned earlier, the sources noted this specific preferred was non-cumulative.
Excellent point to bring back up. That detail is critical here. Because the dividends were non-cumulative, if the company missed a payment, it was gone forever. It didn't pile up.
Right.
Which meant that delaying the redemption wouldn't actually increase the total amount the company owed the preferred shareholders later on. This fact really strengthened the common shareholders' arguments when the lawsuit happened.
Okay, so non-cumulative mandatory redemption in 5 years. What was the catch? Why did it end up in court?
The catch was buried in the fine print of that mandatory redemption clause itself. It said if the company didn't have enough legally available funds on the redemption date, it was required to take all reasonable action. But here's the key part. As determined by the company's board of directors in good faith and consistent with its fiduciary duties to generate the money needed.
Consistent with its fiduciary duties. There it is again, linking it back to the board's duty to common.
Exactly. That phrase explicitly tied the company's effort to find redemption funds directly to the board's existing duties to the common stockholders. It wasn't an absolute command to find the money no matter what. It was find the money if doing so aligns with your duty to the common.
That sounds like a pretty significant escape hatch, potentially.
It certainly turned out to be. So about 3 years into this 5-year term, the VC firm, which, as is typical, had put its own people on the company's board, got unhappy with Oversea.net's growth.
They weren't seeing the returns they wanted.
Right. So they decided, okay, plan B, let's just make sure we get our $150 million back via this mandatory redemption in a couple of years. That's our best path now.
So the preferred holders, represented by their board members, wanted the company to gear up for redemption.
Correct. But here's the legal tightrope for those directors, even the ones appointed by the VC firm. Under Delaware law, their primary loyalty is to Oversea.net's common stockholders.
Even the VC-appointed ones.
Yes. The law expects them to act in the best long-term interests of the common. The court in the case even noted that Delaware law would generally expect directors to oppose or at least delay a redemption if paying it would cause exceptional hardship to the company's core business.
Wow.
Even if the contract seems to require it. Their duty to the common shareholders can override simply following the preferred contract terms if there's a serious conflict that harms the long-term value for common stock.
So what did the common shareholders claim the company actually did because the VC wanted its money back?
The lawsuit, brought by common stockholders, alleged that the VC firm and its directors caused the company to completely change its business strategy well before the redemption date even arrived.
Sounds so.
The claim was the goal became hoarding cash and generating accounting surplus, specifically to be able to make that future redemption payment, instead of running the business to maximize its long-term value for everyone, meaning primarily the common.
What kinds of actions did they allegedly take?
They supposedly stopped chasing potentially valuable acquisitions to save cash. They tried getting bank loans, but the complaint said banks were only interested in lending for growth, not for bailing out preferred shareholders.
Okay.
Then came actions the plaintiffs called extraordinary and damaging. Huge cost cuts, firing key executives, slashing the workforce. But the most dramatic allegation, selling off major business units.
Selling parts of the company.
Yes, including what was described as its main economic engine. And crucially, the lawsuit alleged these valuable assets were sold for less than what the company originally paid for them.
Selling profitable assets at a loss just to build up cash for a redemption that was still years away. That seems counterintuitive to maximizing value.
That was exactly the common stockholders' argument. They claimed these asset sales destroyed the company's future ability to generate revenue and cash. They pointed to revenue dropping from $141 million in 2011 down to just $11 million by 2015 after these sales as proof. Proof that the board's actions, aimed solely at facilitating the preferred redemption, actively gutted the underlying business value for the common shareholders.
But wait, wasn't there that mandatory clause? Didn't the company have to prepare somehow?
Yes, the contract existed, but redemption is always limited by external legal rules. Delaware law, like most states, stops companies from redeeming shares if doing so would impair their capital, basically, using funds beyond their surplus, which is roughly retained earnings plus some other equity accounts.
Okay, the surplus rule.
And they also can't redeem if it would make them insolvent or if they already are. These are legal limits on legally available funds that exist completely outside the preferred stock contract.
So the lawsuit wasn't saying the preferreds weren't owed the money eventually, if legally possible.
Correct. The core argument wasn't about the contractual right itself, it was about the board's actions in the lead-up. The common shareholders argued the board breached its duty of loyalty by managing the company before the redemption was even due, in a way that deliberately prioritized making the preferred redemption possible by generating surplus through harmful asset sales, instead of managing the company to maximize the value of the overall equity, the common stock, by keeping the profitable businesses running.
They were accused of favoring the preferred's exit over the common's long-term value.
Precisely. Even when doing so allegedly required harming the fundamental business, the source of value for the common stock.
And what did the court say? Did the case get thrown out?
No, and this is the crucial part. The court, specifically Vice Chancellor Laster in Delaware, allowed the case to proceed. He didn't dismiss it.
That's significant.
Hugely significant. It confirms that even with a binding contract talking about mandatory redemption, directors still owe those primary fiduciary duties to the common stockholders, and those duties dictate how they handle such contracts.
So the contract doesn't override the duty?
No. The court signaled that directors could potentially breach their duty if they take actions specifically to make a preferred redemption happen, if those actions harm the long-term value for common shareholders. Especially if the redemption isn't absolutely required yet and funding it means, say, selling off core assets at a loss. The judge basically said the contract doesn't give directors magic powers to ignore their duties. They have to operate within the world where that contract exists, but always ensure their path forward aligns with their duty to the common.
And the non-cumulative dividend part helped the common's case.
Yes, because delaying redemption didn't punish the common shareholders by racking up huge unpaid dividend arrears for the preferreds. It made the choice between preserving the business for the common versus paying the preferred starker.
So the big lesson here for an investor from ODN Holding is what? That mandatory isn't truly mandatory.
That's the nub of it. A mandatory redemption clause on preferred stock is not an unconditional promise like a bond's maturity date. It's contingent.
Contingent on what?
Contingent on the company having legally available funds, enough surplus, staying solvent under state law, and contingent on the board's discretionary decision to actually take actions to generate those funds, being consistent with their primary fiduciary duty to the common stockholders.
So if getting the money together requires actions that hurt the business long-term for the common,
the board might decide, consistent with their duty, not to take those extraordinary actions, which could delay or even effectively prevent the redemption despite what the contract says.
wow, that adds a whole different layer of risk. It's not just about interest rates making a call likely or not.
Exactly. It goes right to the heart of corporate governance law. It shows how the board's duty to common shareholders can create real uncertainty around preferred stock redemption, especially maybe in private companies or situations of distress. You can't just rely on the word mandatory in the contract. You have to think about the company's health and the legal duties driving the board's decisions.
That ODN case really drives home a surprising risk. Okay, so we have call risk and this deeper redemption risk tied to fiduciary duty. What other big risks should investors know about with preferreds, according to our sources?
Well, there are several others commonly mentioned that affect preferred share prices and income. First, plain old interest rate risk.
We touched on that with call risk.
Right, but it's also a direct price risk. For those fixed-rate perpetual preferreds especially, their price moves inversely to long-term bond yields. If benchmark rates go up, the fixed dividend on your existing preferred looks less attractive compared to new issues, and the price of your preferred will likely fall.
Makes sense.
Now, floating rate or late reset preferreds behave differently. They might even benefit from rising rates, but they have their own sensitivities.
Okay, what else?
Credit risk. This is a big one. Preferred shares are very sensitive to changes in the issuer's perceived creditworthiness.
Because they're junior to bonds.
Exactly. Since they rank below bondholders, if the market starts worrying about the company's financial health or its risk of defaulting on its debt, the price of the preferred stock will often fall, sometimes quite sharply, even more than the company's bonds.
Okay.
This is especially true for preferreds with long durations, like perpetuals or ones already trading at a discount. Watching credit ratings from agencies like S&P or Moody's is key here.
Got it. What about the flip side of being called too early? What if they don't call it when you expect?
That's called extension risk. It's the risk that the issuer doesn't call the preferred shares when investors thought they would.
Why would that happen?
Maybe interest rates have risen a lot since the shares were issued, making it too expensive for the company to refinance with new prefers at higher rates. Or the company might just be in bad financial shape and simply can't afford to redeem them even if they wanted to.
And the impact on the investor.
You, the investor, who might have been counting on getting your capital back on that call date, are now forced to hold the security for longer, maybe many more years. You might be stuck with an unattractive fixed dividend rate if market rates have gone up, or stuck holding a security whose price has fallen if it's trading at a discount. You're locked in longer than you planned.
Stuck when you want it out.
Yeah.
Okay. Any other risks?
Liquidity risk. The market for preferred shares, generally speaking, is smaller and less actively traded than the common stock market for the same company.
Meaning it's harder to buy or sell.
It can be. It might be harder to buy or sell quickly at the price you want. You often see wider bid-ask spreads, meaning the price you pay to buy is a bit higher and the price you get to sell is a bit lower than the last quoted price. Less liquid.
Okay. And taxes. We mentioned the tax source.
Absolutely. Tax risk is crucial because taxes directly hit your actual after-tax return. Changes in tax laws, how dividends are taxed, how gains are taxed, can really change how attractive preferreds are compared to, say, bonds.
And one more.
Inflation risk. Especially for those common fixed-rate perpetual preferreds. They pay a fixed dividend, right?
Right.
Well, if inflation is rising, the purchasing power of those fixed dividend payments just gets eroded over time. Your nominal income stays the same, but its real value, what it can actually buy, goes down.
That's a pretty comprehensive list of potential downsides beyond just the advertised yield. Makes sense. We've mentioned a few types already, but can you quickly recap the key structures from the sources and how they tie into these risks?
Sure, a quick run through. You've got the basic fixed-rate perpetual, simple, fixed dividend, no maturity date, highly sensitive to interest rates and credit risk.
Okay.
Then rate reset preferreds. They start with a fixed rate for, say, 5 years. Then the dividend rate resets based on some benchmark, like a 5-year treasury yield, plus a fixed spread. They're usually callable on those reset dates.
So they adjust somewhat to rates.
Yes, but they become sensitive to both interest rate movements and changes in the issuer's credit spread, which is reflected in that reset spread component.
Got it.
Floating rate preferreds have dividends that reset much more often, maybe quarterly, based on short-term rates like the 3-month T-bill rate plus a spread. These benefit more directly if short-term rates rise quickly. We already covered cumulative versus non-cumulative in detail. That's all about dividend payment security. Callable, the issuer's right to redeem, we've hit hard.
Yes.
There's a rare type called retractable. That's the opposite of callable. It gives the holder, the investor, the right to sell the shares back to the issuer after a certain date. offers flexibility to the investor.
Interesting.
And sometimes you see participating preferreds. They might get extra dividends if the company hits certain targets, or they might get more than just par value in a liquidation, kind of an equity kicker.
Okay, lots of variations. So given all this complexity, how should an investor actually analyze a specific preferred share they're considering?
Well, as we discussed, step one is look at the market price. Is it trading above par? If yes, immediately think call risk. Your focus shifts to calculating the yield to call because that's your most likely return scenario.
And if it's trading at a discount?
A call might be less likely soon, but you still absolutely need to understand all the terms. And regardless of the price, premium, discount, par, you must calculate and understand the yield to worst, YTW.
Always calculate YTW.
Always. Remember, that tells you the lowest possible return based on all the contractual call possibilities and this scenario where it's never called. It's your baseline, your reality check.
What else?
You absolutely have to assess the issuer's creditworthiness. How strong are their financials? How much debt do they have? What's their cash flow situation? Remember, preferreds are junior to debt, so credit quality matters immensely.
Look at the company's health.
Definitely. And then, obviously, read the fine print in the prospectus. Is it cumulative or non-cumulative? Is it fixed, floating, or reset? When exactly are the call dates? What's the call price schedule? Know the specific terms inside out.
Makes sense. Due diligence is key. Let's pivot now to those tax considerations for U.S. investors. That Montague law source seemed pretty focused here, especially maybe for those private company preferreds, where these redemption issues can really bite.
Taxation is absolutely critical. It determines your actual after-tax return, which is what you can spend. So for U.S. investors getting dividends, cash dividends are generally taxed in the year you receive them.
Ordinary income?
Sometimes. But for individuals, they can qualify for the lower long-term capital gains rates, often 15% or 20% if they meet certain holding period requirements and the dividend qualifies. Not all preferred dividends do, though.
Okay, potential for lower rates. What about non-cash dividends?
Payment in kind, PIK dividends. This is where instead of cash, the company gives you more preferred shares or maybe just adds the dividend amount to the liquidation preference you're owed later.
So you don't get cash now?
Correct. But, and this is the kicker, you usually still owe tax on that PIK dividend income in the year it's accrued, even though you didn't receive any cash.
Ouch. Phantom income.
Exactly. It's called phantom income because you have a tax liability without the cash flow to pay it. It reduces your effective spendable return from that preferred until you eventually sell or get redeemed.
Good to be aware of. What about non-U.S. investors?
For non-U.S. investors holding U.S. preferred stock, dividends typically face a flat 30% U.S. withholding tax right off the top, unless a tax treaty between their country and the U.S. reduces that rate.
30% withholding? That's steep.
It is. It's a key reason why many foreign investors prefer investments structured to generate capital gains rather than dividends, because the U.S. generally doesn't tax capital gains earned by non-U.S. persons on stock sales, with some exceptions like real estate.
And for the company issuing the preferred, any tax breaks for them?
No, not on the dividends. Unlike interest paid on debt, which is tax deductible for the company, dividends paid on preferred stock are not tax deductible. That makes preferred stock a more expensive form of financing for the company on an after-tax basis compared to debt.
Okay, clear difference from bonds there. What about when an investor actually sells or gets redeemed? How is that exit taxed?
Capital gains taxation on exit? It depends on how you exit. If you just sell your preferred shares to someone else in the open market, standard capital gain or loss treatment.
Like selling common stock?
Pretty much. Hold it for over a year, individuals usually get the lower long-term capital gains rates. Simple enough.
What if the company goes public, an IPO?
If, as part of an IPO, your preferred shares automatically convert into common stock, which is a common feature in VC deals, that conversion itself is usually a non-taxable event. You don't recognize gain or loss right then. Your tax basis just transfers to the new common shares, and you only pay tax when you eventually sell those common shares down the road.
Okay, tax deferred until final sale?
Yeah.
What about redemption by the company?
Redemption by the company where they buy the shares back directly from you, that's where it gets trickier tax-wise. It's taxed as a capital gain or loss only if the redemption qualifies as a sale or exchange under specific, quite complex IRS rules.
Sale or exchange rules, what do they look at?
They look at things like, did the redemption significantly reduce your percentage ownership in the company? Did it completely terminate your equity interest? If it meets those kinds of tests, it's capital gain.
And if it doesn't qualify as a sale or exchange?
then some, or potentially all, of the money you receive in the redemption could be treated and taxed as a dividend.
Dividend treatment,
Wrong.
which could mean higher tax rates for individuals.
Could mean higher ordinary income rates for U.S. individuals, yes. And crucially for non-U.S. investors, if it's treated as a dividend, it could trigger that nasty 30% withholding tax they were likely hoping to avoid by having a redemption instead of regular dividends. The structuring of the redemption matters hugely for taxes.
Wow, okay. The source also mentioned something called QSBS. Sounded important for private preferreds.
Yes, qualified small business stock, QSBS. This is a potentially huge tax benefit, mostly relevant for investors in private companies, like those VCPE deals. If the company meets certain criteria, the sources mention things like having gross assets under $50 million when the stock was issued, being a USC corporation, being in an active qualified business, not just investing, etc.
Okay.
And you, the investor, hold that preferred stock for more than 5 years. You might be eligible to exclude a massive chunk of your capital gain from federal income tax when you eventually sell or are redeemed.
Exclude the gain. How much?
For stock acquired after September 2010, potentially 100% of the gain, up to a limit, of course, usually the greater of $10 million or 10 times your original investment basis.
100% exclusion up to $10 million. It's incredible.
It's a game changer. It can completely transform the after-tax return potential of a private preferred investment compared to a public one where QSBS usually isn't applicable. It's a major incentive for investing in qualifying small businesses.
Definitely something to look for in private deals. The source also mentioned leveraged recaps and taxes.
Right, leveraged recapitalizations. This is a scenario where a company takes on a lot of new debt, borrows heavily, and then immediately uses that borrowed cash to pay out a large, often one-time distribution to its shareholders, including preferred holders, often structured as a massive dividend.
Okay, borrowing to pay shareholders. How's that taxed?
The tax treatment hinges on the company's earnings and profits, or E&P. Think of E&P as a company's accumulated taxable income over its history, its capacity to pay dividends from a tax perspective.
Right.
The distribution is first taxed as a dividend to the extent the company has positive E&P.
Dividend first.
Then, any amount distributed above the E&P level is treated as a tax-free return of capital, which reduces your cost basis in the stock.
Return of capital. Reduces basis.
Finally, if the distribution exceeds both the E&P and your basis in the stock, that excess amount is taxed as a capital gain.
Dividend, then return of capital, then capital gain.
Okay. For non-U.S. investors, that initial dividend portion can trigger the 30% withholding, which again makes these structures less attractive for them compared to a redemption properly structured as a sale or exchange, which usually avoids withholding. For the company, they get to deduct the interest on the new debt they took on, but the big dividend payment itself is not deductible.
So, tax planning around how you receive your money-back redemption structure, QSBS eligibility, avoiding phantom income, is absolutely vital.
Absolutely vital. Your headline yield or potential gain is only part of the equation. The tax rules significantly shape your actual net return.
Okay, last area. What about just buying these through, say, an ETF? Are there preferred stock ETFs?
Yes, there are. The sources mention examples like PFF or FPE. Preferred stock ETFs offer U.S. investors a pretty convenient way to get exposure. You buy shares of the ETF, and the ETF holds a whole portfolio of different preferred stocks.
I could get diversification.
You get diversification across different preferred issues, which is definitely helpful compared to putting all your eggs in one basket.
But do the ETFs avoid the risks we talked about?
No, and that's crucial to understand. The ETFs carry all the same underlying risks as the individual preferreds they hold inside. Interest rate risk, credit risk, call risk, extension risk, all those are baked into the ETF's price and performance. The ETF wrapper doesn't make those risks disappear.
Okay, same underlying risks. Any risks specific to the ETFs themselves?
Yes, the sources point out a couple. A big one is sector concentration.
Concentration? I thought they were diversified.
Diversified across issues, yes, but often not across industries. Think about who issues the most preferred stock. It's heavily dominated by financials, banks, insurance, utilities, and real estate companies like REITs. So many preferred ETFs end up being heavily weighted towards just those few sectors. If something negative hits the banking sector, for example, your diversified preferred ETF could take a big hit because it holds so many bank preferreds.
So lack of sector diversification.
Yeah. Another potential issue is exposure to speculative or jump-rated preferreds. Depending on the ETF's strategy, it might include lower quality preferreds to try and boost its yield. That obviously adds more credit risk to the ETF portfolio. You really need to look under the hood of any preferred ETF, check its sector weights, its credit quality breakdown before investing.
Okay, good advice.
Yeah.
So let's try to pull all this together now. After this deep dive, what does it all mean for you, the income investor who might be looking at preferred stocks?
Well, I think the first thing is preferred stocks can be a useful part of an income portfolio. They do offer potential advantages, often higher yields than you might get from comparable bonds or common stock from the same issuer.
Right, yield attraction.
And you get that priority over common shareholders for dividends when times are good and in liquidation if things go bad.
Okay, those are the positives.
But, and this is the big takeaway from digging into all these sources, they are far, far from being simple, low-risk income machines.
Not like a savings account.
Not at all. They are complex hybrids. That preferred status gives you priority over common, yes, but the dividend itself doesn't have the same legal guarantee as bond interest. Companies can suspend it.
Okay.
Call risk is very real. If rates fall, you could lose your high-yielding investment just when you want it most. Credit risk is significant. Their prices react strongly to the issuer's perceived health. Extension risk can trap you longer than you planned if rates rise or the company struggle.
And that big one from the ODN case.
And that huge one, yeah. Even a mandatory redemption date isn't an ironclad guarantee. It's subject to the company having the legal ability to pay enough surplus, solvency, and, critically, subject to the board, deciding that taking steps to make that payment aligns with their primary duty to the common stockholders. If paying you back hurts the common shareholders' long-term prospects, the board might just delay or not take extraordinary measures.
That's a risk many probably don't fully appreciate.
I suspect not. And then we saw how vital understanding the tax implications is for your actual take-home return in the U.S. phantom income from PIK, the complexities of redemption taxation, the potential huge upside of QSBF if it applies.
So the bottom line is, know what you're buying.
Exactly. Investing successfully in preferred stock demands real homework. You need to understand the specific terms of that individual security. Call dates, call prices, cumulative or not, fixed or floating or reset. You need to analyze the issuer's financial strength, their credit risk. You need to grasp the legal context, especially around redemption and fiduciary duties. And you absolutely must understand the tax consequences for your specific situation.
It sounds like a security with potentially attractive features, but layered with complexities and risks that really require a deep dive.
That's a perfect summary. They demand a deeper understanding than many investors might initially assume.
Well, hopefully this deep dive has provided a shortcut to grasping those critical nuances, especially that surprising reality check on mandatory redemptions that you don't just see on the surface.
Hopefully it gives you a much clearer and perhaps more cautious perspective when you're evaluating preferred stock opportunities from now on.
So maybe a final thought for you, the listener, to chew on based on everything we've discussed today. Given all these layers of risk we've unpacked, market stuff like interest rates and credit quality, but also these tricky legal nuances around board duties impacting mandatory redemptions, how does that headline yield you see advertised for a preferred stock truly measure up against the full, complex spectrum of its actual risks?
Something worth thinking about carefully.
Indeed. Thank you for joining us for this deep dive.